Good afternoon, ladies and gentlemen. I'm Megan Olson with the Investment Advisor Association, and I welcome you to our webinar, The Value of Active Management. During the webinar, all participants will be in a listen-only mode. You may submit questions to the speakers at any time during the webinar by typing them through the chat feature. Only the speakers will see your questions. Questions will be addressed as time allows. As a reminder, today's webinar is being recorded April 22nd, 2020. I would now like to turn the presentation over to Karen Barr, IAA President and CEO. Karen?
Thank you, Megan. I just want to make a note that this session is closed to the media, so if there are members of the media who may be on the call, we'd appreciate your dropping off now. And welcome to all of you who have taken the time to join us today. I am pleased to be joined on this session by Dave Lafferty and Darby Nielsen. Dave is Senior Vice President and Chief Market Strategist for Natixis Investment Managers, and he's also Chair of the Active Managers Council. Dave will present the highlights of the Council's most recent white paper, which he authored, titled A More Balanced Narrative, Setting the Record Straight on Active Management. And Darby will discuss the effects of passive and active management on market dynamics. Darby is Managing Director of Research at Fidelity Investments, and he's Chair of the Council's Research Task Force. The full bios on their distinguished careers are at the back of this deck for your reading pleasure. We are going to discuss how, in many ways, folks have been looking in the wrong places and at the wrong measures to evaluate active management. They've been looking at persistence, at scorecards, short-term returns, market replication, but investment managers are not hired to generate alpha on a daily basis. They're hired to achieve investors' goals over the long term. So the way that the media and some market participants talk about performance and time horizons is really misaligned with the value that we should be trying to provide to investors. Folks have also been missing the big picture perspective on how valuable active is to the markets. We're going to discuss those themes today. But first, I'll give you a little background on the IAA and briefly review what the IAA Active Managers Council has accomplished to date. The IAA is a trade group representing investment advisor firms, from the largest asset managers to the smaller boutiques that make up much of the industry. We advance the interests of this community, including educating policymakers about how critically important investment managers are to investors, to the markets, and to the economy. One of the most critical challenges facing our industry is the overly simplistic narrative that has arisen over active and passive management. The narrative seems to be that passive is cheap and therefore good, and that active is more expensive and therefore not so good. This narrative has really created a false dichotomy, pitting active versus passive, and that does a serious disservice to investors. A number of our members came together to form the Active Managers Council to create a more balanced narrative around this topic. To that end, we have engaged in research, education, communications, and policy efforts. We, in fact, have published research from a number of leading academics and experts. We started out with a seminal piece from Professor Martin Kramers and his colleagues John Fulkerson and Tim Riley. The piece reviewed more than 300 papers and concluded that the conventional wisdom is unduly negative on active management. In fact, the paper finds that active management adds value, that managers have skill, and that you can identify skilled managers in advance. We also published a paper by Professor Russ Wormers out of the University of Maryland discussing how important active management is to market efficiency and to price discovery. And we followed up on that with a council literature review of a very large number of papers that supplements that piece. Most recently, we published a piece setting the record straight on active management, which Dave is going to discuss in a moment. We have engaged with a wide range of policymakers to better educate them about active management. We are trying to dispel misunderstandings that they might have about active and passive, and certainly misunderstandings are out there, and to ensure that they don't put their finger on the scale between active and passive in legislation and rulemaking. And we've engaged with the media and the public to ensure that they understand that active management adds value, that all investors are active investors, including that investing involves a wide spectrum of active decisions, including index strategies. Active and passive are both critically important to investors, but can play different roles. We are also underscoring the point that active management is critically important to the global markets. We've been very successful in reaching the press and the public with op-eds, letters to the editors, and PR outreach. And a lot of our messaging has now been reflected in some of the press that you see, so that there's a wide range of points out there that are more represented rather than the imbalanced or inaccurate point of view that's dominated the narrative. In fact, we have seen a consistent increase in the positive portrayal of active management. We track stories in major outlets, and in fact, March was our best month yet, with a better ratio, 2-to-1 ratio of positive to negative stories, and our strongest message pull-through yet. As I mentioned, the council was established by members. It is member-driven and member-funded. It is led by a steering committee of 9 firms that have made substantial contributions to these efforts, with more than a dozen at-large members strongly supporting our efforts as well. We've built a strong foundation in our first 2 years that has helped balance the narrative between active and passive. Please reach out to us with any questions. We certainly would be delighted to have more of you join the council's efforts. Check out activemanagers.com for our research, blogs, videos, and follow us on Twitter and LinkedIn. With that background, I will turn it over to Dave, who will discuss the council's recent white paper. We will respond to questions after each section. Dave?
Thank you, Karen. Hopefully everyone can hear me. Really appreciate the opportunity to be on the call. And I know everybody's life is very different in the world of lockdown. So we appreciate the time that you give us on what we think is a really important subject. So as Karen said, I will summarize a recent piece that the council has produced called A More Balanced Narrative, Setting the Record Straight on Active Management. If you can move forward, Karen, just one slide. We think about this balanced narrative. I think one of the most important things we have to do is sort of accept and recognize some of the key strengths that passive has offered investors. I think Karen has highlighted this. The council's mandate is to sort of push back against the overly simplistic narrative that passive is good and that passive is good and active is bad. But really, we also need to accept that they can both play an important role in portfolios. And so with that, we sort of very quickly, we sort of highlight many of the benefits here that you would see within passive management. The idea of, relatively strong performance, particularly in certain asset classes, maybe that are rightly or wrongly perceived as being more efficient. Clearly, there's a benefit to having lower fees, and we'll certainly dive more into that. And there's also this perspective that in many cases, indexes or passive management can be more tax efficient. And while all those are true, if we move to the next slide, Karen, we think all those strong benefits of passive need to be put into a broader context. Again, to have a bit more deeper narrative relative to active. So certainly performance has been strong in areas, but as we'll highlight, it really varies by asset class, by time period, and by market cycle, as well as a whole bunch of other variables that might play into it. So it's not simply that passive is sort of winning everywhere and all the time, and we'll spend a lot more time on that in a few minutes. In terms of fees, fees are certainly important, there's no doubt about that, but fees should always be evaluated within the context of the value that's being added. And so as we'll show in a little bit, fees are always important, but we don't think they should be all important in the decision making. We think it's misleading investors to think if you just buy the lowest fee product, you'll get the right or the best or the most appropriate results for that particular client. And then tax efficiency has to be put in a larger context too. Sometimes there's confusion between the tax efficiency of indexes and the ETF structure itself, many passive investments being housed within ETFs. We would also highlight that over half the investable assets out there, particularly around retirement accounts, the tax efficiency argument obviously wouldn't apply. And then I would also remind folks that there's nothing about active management inherently that makes it tax inefficient. There are many active managers that use loss harvesting tools and other strategies to make their actively managed portfolios more tax efficient. So again, these are all solid arguments, but they need to be put in a more broad context. If we move to the next page, we'll sort of walk through kind of the agenda of what I'm going to cover over the next 15 to 20 minutes. You see a thumbnail sketch of kind of the paper that's available to be downloaded at the Active Managers Council website. And really what I'm going to address are kind of the three main arguments or critiques that you often hear passive investors level against active managers. And they sound a little bit like this. First, there's an empirical evidence that active managers on average aren't or don't outperform the indexes. And we're gonna spend some time there. Then there's a theoretical argument that active managers on average can't. Sometimes this is referred to as the zero-sum theory. And we're gonna dive into why that's important, but maybe not as airtight as people like to believe. And then the third argument that's often leveled against active management is that, well, even if you could outperform, there'd be no way to identify those outperforming managers in advance, sort of the selection argument. And we clearly don't think that's true. I'll finish with just a slide or two on the way that active managers are actually adapting relative to the pressure that passive management has brought. And we think there's actually quite a good story here. So that's kind of the agenda I'll tack. If we move to, the next slide, Karen, perfect. So the first thing we want to talk about sort of the performance, and the performance is often summarized in what we refer to as kind of the industry scorecards. One is the S&P index versus active report, often referred to as the SPIVA report. And then many people on the call will also be familiar with Morningstar's active passive barometer. So two very interesting reports. They cover much of the same ground. We highlight though that the methodologies have some similarities, but some significant differences. The S&P, the SPIVA report does not include fees when it calculates the performance of the passive alternative, whereas Morningstar does include the fees. Also, the way different share classes are handled are a bit different as well. And the SPIVA measures the number of actively managed funds that underperform, while the Morningstar Active Passive Barometer measures the number of funds that active funds that outperform. So similar ideas, but these are sort of, and you'll hear me refer to the industry scorecards as we go forward. This is really kind of where the active passive debate has often been, where the rubber has met the road, and where a lot of the broad financial media gets a lot of their data from. So we'll dive into these and spend a little time with this in terms of what are the factors that are driving active versus passive. If we move to the next slide, one of the most important things that we highlight is that it doesn't matter whether it's one of these two industry scorecards or any one of the 1,000 academic research papers that have been done, different methodologies for how you calculate active returns versus passive returns can lead to vastly different results, especially on a whole bunch of variables that we mentioned, whether we're looking at just gross returns or net of expenses, whether the benchmark or index fees are included in the calculation of passive returns or not, which benchmarks you're using. Some studies use broad industry benchmarks like the S&P 500 for all large cap US equity. Some studies use the specific prospectus benchmarks like, say, the Russell 1000 value or the Russell 2000 growth. How we handle share classes is important because there have certainly been some trends over the years in which share classes and the expense ratios of those share classes and how they affect performance. Obviously, the results will vary based on time period and horizon. We spend a lot of time thinking about survivorship bias and something called reverse survivorship bias. I would summarize this by simply saying, yes, if you only look at surviving active funds, you will overstate the strength of active. But if you assume that all funds that were closed underperformed, you're sort of underestimating the results of active management. Mutual fund companies and asset managers close funds and strategies for all kinds of reasons that don't include bad performance. So in a lot of ways, the numbers are overstated to the downside. There's also a question as whether we're trying to measure the outperformance of the vehicle or the skill of the manager, and therefore should distribution costs be included or not included. And then many of these studies adjust for risk-adjusted returns. So yes, some clients only care about their nominal returns, but in an academic framework, investors should always care about what their risk-adjusted returns are. Long story short, you can get wildly different results even by looking at the same numbers, just by using different methodologies and different assumptions. If we slide to the next page, here we just offer one example. This is kind of, if you're an investor and you're wondering, you ask yourself the question, I wonder how active managers have done in the high yield bond space over the last 10 years. Well, going to the two main industry scorecards would give you wildly different results. Morningstar would tell you that over the last 10 years, through the middle of last year, that almost 60% of active high yield bond managers have outperformed, while the S&P index versus active report would say that number is under 5%. So again, you just get sort of a sense of, if you make a few changes to your assumptions, you can get wildly different results. If we slide to the next page, I sort of just highlight the period effect and the cyclical effect. So here we've just taken a couple of different Morningstar categories, US real estate funds and corporate bond funds. And sure, if you said over the last 3 to 5 years, wow, real estate funds have really struggled, but in the last year, 70% of them have outperformed their indexes. So clearly something is different is going on here. Almost the mirror image in sort of corporate bonds. You might say, wow, 60% of corporate bond actively managed corporate bond funds have outperformed over the last 3 and 5 years. But in the last year, only a little bit more than a quarter of them have outperformed. So again, this is just a very tiny slice of the broader reporting, but it gives you a sense that this narrative that all funds in all categories are struggling relative to passive. It turns out that a more nuanced and deeper dive into the performance of active management shows that there's a lot of variability between strategies, styles, and different time periods. Many managers are doing quite well, and some are struggling in different periods, and it really depends on the market cycle and some other variables we'll talk about in a minute. If we slide to the next page, thanks, Karen. Here we look at just one smaller slice, although this is one of the bigger asset classes. This is active US large cap blend managers, so core US large cap relative to say an S&P 500 or the large passive benchmarks. And here we go all the way back to 1984, showing data, the long cyclical trends that have occurred in active versus passive. You can, as the line goes down, this is the relative performance between the aggregation of all the active large cap blend funds divided by the performance of the S&P 500, again, indexed to 100 at the beginning of 1984. You can see we had a 5 or 6 year period where actively managed funds struggled. We had a 4-year period where they dramatically outperformed. In the early 90s, they underperformed for about a 5-year period in the mid to late 90s. And then active managers had a fantastic 11-year run from basically 1999 in the tech bubble through the beginning of the great financial crisis. And as most people are aware on the call, large cap active US has struggled since then. I think this really shows that it's a much more interesting and nuanced story. People will look at the last 10 years and sort of conclude that active management has really struggled. Whereas in a longer perspective, we can really see that active management, like all things, goes through different phases where it underperforms and where it outperforms at other points in time. If we slide to the next one, Karen. So why does performance vary across time? I won't go into detail here, but I will highlight a really important fact that people should know, that if you add up all the active managers in a particular category, you will not get a portfolio that looks identical to the benchmark of that category. There are systematic differences between the way active managers run portfolios and the way indexes are constructed. And these systematic differences go a long way to explaining why active managers on average and in aggregate would fare better in some market cycles versus other market cycles. And I'll just highlight very quickly a couple at the bottom because they are relevant for the current cycle. So not surprisingly, cash and market direction are important. So obviously in a rising market, active managers who tend to own some percentage of their portfolio in liquid or cash investments, not fully replicating the overall market exposure, they may tend to lag. They'll have a little bit of a headwind in up markets, and they'll tend to have a little bit of a tailwind in down markets. Now, don't misread that statement. That doesn't mean that on average, active managers will outperform in down markets. They may not. We simply highlight that as a single variable. This tends to be a headwind in rising markets, a tailwind in falling markets. That isn't an opinion, that's sort of basic portfolio math. We also highlight market cap distribution. Most active managers in aggregate cannot be overweight the largest stocks at the same time in an index. So not surprisingly, when the largest stocks in a market cap index have the strongest performance, that tends to be a headwind for active managers. And when smaller cap stocks, maybe the Russell 2000, but even think about smaller within large cap, the bottom 400 stocks in the S&P 500, when those small and smaller cap stocks outperform, that will tend to be a tailwind to active managers. And this doesn't apply just to equities. You see the same similar trends in bond portfolios. Most active managers will have a little bit more yield, a little bit more credit. So generally speaking, not in every environment, but when credit does well, active managers have a bit of a tailwind. And when credit underperforms or credit spreads are widening, that will be a little bit of a headwind. Again, none of these are hard and fast rules, but they give you a sense that there are systematic differences between active managers and their underlying indexes. And when those differences are in or out of favor, they will tend to drive in aggregate whether the average active manager is doing better or worse. If we move to the next slide, really the key takeaways from me from the first part, we believe that the industry scorecards are helpful and can even be insightful, but they are not gospel. They are hardly precise to any stretch of the imagination. Remember, their findings can be radically different simply because of small methodology or assumption changes. We think that a deeper look at the empirical evidence highlights that performance between active and passive has often varied by asset class, time period, and market environment. And we don't think people should extrapolate the struggles that large cap US funds have had in the last 7 or 8 years to sort of indict all active managers in all the other spaces. And we do think that if you understand the systematic differences between active managers and their benchmarks, you can have a much more robust discussion about why active managers are outperforming or underperforming in a typical environment. The most important takeaway here is that we think that the notion that active managers do well in some environments and not in other environments really makes it much harder to come up with these catch-all arguments that you often hear leveled against active managers, that markets are too efficient or managers lack skill. If you remember those slides from the previous page, it's highly unlikely that markets were massively efficient in one period, and that meant active managers struggled, and all of a sudden markets became wildly inefficient and active managers did fantastic. You know, likewise, it's unlikely that all the managers were foolish in one period and underperformed and all of a sudden became geniuses in the next period. We think these catch-all arguments are way too simplistic and aren't supported by the changing cyclicality that we see between active performance doing better in some periods and worse in other periods. On the next slide, we really attack the second argument. It's this idea that there's some kind of arithmetic proof that active managers on average can't outperform. This was first popularized by Bill Sharpe in the early 90s. It's often referred to as the zero-sum theory I mentioned earlier. It sounds something like this. You've probably heard it. All investors together, all active managers and investors form the market. On average, everybody's gain has to be somebody else's loss, or everybody's positive alpha has to be offset by everybody else's negative alpha. So when you add it up, you basically get everybody in aggregate alpha or excess return has to be zero, and then the active managers charge a fee. So it's this idea that there's some kind of proof that this is the case. And while we'll argue that the zero-sum argument is powerful, it is true that active managers do have to take alpha from somebody. We think there's a real misunderstanding of how, or mismatch of how this lines up against how active and passive is measured. So a couple of ways that that's happened, or that happens, is we highlight there's really two mismatches here. The first one we call skew, and the second one is slippage. The most important thing to remember with the zero-sum theory is that when we're measuring alpha or excess return, we're talking about total dollars. Every dollar that somebody earns is a dollar that somebody else loses. That's the zero-sum theory. But remember, when we go back to the industry scorecards, we're not measuring dollars. We're measuring what we call hit rates or success rates. And the dollars and the hit rates do not need to align with each other. So while the zero-sum theory measures dollars, the industry scorecards, which you often read about, are measuring percentage of managers or hit rates. So we have two things, skew and slippage. Skew is how this could be moved across managers, and slippage is how you could lose it in between categories of managers. We highlight that on the next slide. So here we talk about skew, and on the left-hand side, we show two very similar tables here. We have 5 managers on both sides, and in both scenarios, we've given them assets and a certain return of alpha, and we've made it so the total sum of alpha is 0% and $0 at the category level. But notice if the returns are skewed across managers, and on the left-hand side, we've given one of the managers a lot worse returns than everybody else, well, they suck up a lot of negative alpha and they provide positive alpha for everybody else. And so in this particular case, we show that the zero-sum alpha doesn't mean that half the managers will outperform. Here, 60% of the managers are outperforming. On the right-hand side, we could also skew the assets. So we give them similar returns, but we make one of the managers much bigger. The bottom manager is much larger than the other. He has good performance, so he's sucking up a lot of the positive alpha, leaving more than 50% of the managers underperforming. So again, it isn't at all true that just because the alpha has to equal 0, that 50% of the managers have to underperform. On the next slide, we highlight this other term called slippage. And here we just point out that these measurements are not a closed system. So we've just made up an example here, which is the US bank loan category, for example, in Morningstar. And we highlight that, yes, while the zero sum of alpha across everybody that is trading bank loans, and that might include pension funds, CLO managers, insurance companies, other mutual funds that are, non-US mutual funds, while they are all trading amongst themselves, and we may, sort of grant that the alpha may be 0, it doesn't mean that the alpha within that category that we are measuring is actually 0. It may turn out that one of those categories is systematically taking alpha from other investors, or maybe it's systematically conceding alpha to other managers. If we move to the next slide, we sort of sum up this key point by saying, yes, it is true that alpha is hard to come by and you have to take it from somebody else. But simply assuming that alpha equals 0 does not mean that the hit rates on the scorecard have to be lower than 50%. And we show that alpha can both slip and skew across different managers. So when we add it all up, we do agree that Sharpe's zero-sum arithmetic is very compelling. Again, you have to take it. It means that active management is not an easy game by any stretch of the imagination. However, it does not in any way, quote, prove, again, people highlight this as a mathematical proof, that on average, active managers can't outperform. As we move to the next slide, the third and final sort of argument leveled against active managers is that it's really hard to find managers. Even if they could outperform, you could never identify them in advance. And we think this is also a bit off the mark. So the first thing that we highlight on this slide is usually when people try to identify outperforming managers, they over-rely on something called performance persistency, or think of that as performance consistency. And it's sort of, there's this search for persistent manager outperformance. We would highlight that while consistency or persistency of outperformance is great, we'd rather have it than not, it shouldn't get in the way of making money in the long term. Karen really hit on this. What's important that investors are generating the best returns they can, or the best risk-adjusted returns that are designed to meet their goals. The goal isn't to sort of outperform the index every day or every week or every year. And so again, most investors, as we highlight on the right-hand side, would probably have a manager that has a higher return and maybe underperforms a bit more often than a manager that maybe outperforms more than 50% of the time, but has a lower return over their investment horizon or over the long term. And I would argue that most active managers, when you speak to them, completely understand this inherently. Most will concede that good active managers need periods of short-term underperformance. That sort of, coils the spring and allows for the longer periods of outperformance where they can generate some excess returns. So in our view, a lot of people try to equate persistency with the ability to find a manager, and that's really off the mark in our view. If we go to the next page, we do like to highlight there is no magic formula for identifying great performers in the future, but there's been an enormous amount of research done on this. And again, for the sake of this webinar, we'll move as quickly as we can. We've just highlighted a few different variables that are commonly cited in the research. And here I'll come back to cost. Remember we said early, cost is important, but it's not all important. Our view is that cost is important, and maybe it's skewing your manager search away from the most cost prohibitive. It doesn't necessarily mean if you buy the cheapest manager, you'll always get an outperformer. But generally, some of the most cost prohibitive make that hurdle much higher. We also highlight portfolio efficiency, or what some people refer to as benchmark differentiation. This is just the idea that a good active manager has to be different enough from the benchmark to actually outperform the benchmark. I call it portfolio efficiency. What I really mean is enough of a particular portfolio invested in things different than the benchmark. That's the only place alpha can come from. The things in the benchmark can only generate beta. And then when you combine benchmark differentiation with a longer time horizon, there are several studies that have been done that show that investors who have a longer time horizon, that are more focused on fundamental economic signal as opposed to short-term trading noise, when combined with less benchmark overlap or more differentiation, those two variables can also be a good source of finding outperformers. On the next slide, we go back to this idea of cost really quickly. Again, this is from the Active Passive Barometer last year. They do a very interesting study that you can see in the color on the right-hand side, just comparing the top decile versus bottom decile active manager performance by cost. And here, in this particular period, we noted that for the 10-year period, in 17 of the 21 categories that Morningstar analyzed, moving from the highest decile expense ratio to the lowest decile expense ratio worked in 17 of those 20 categories, and on average increased your probability of finding a manager that would outperform by 21 percentage points. So again, fees are not all important, but they are important. If we move to the next slide, we highlight benchmark differentiation. Nothing more than I already mentioned. Remember, only the portion of the benchmark that is different, and only the portion of a strategy of an actively managed fund that is different than the index can actually drive excess return over that index. So there are good reasons to have some overlap with the benchmark, but that has to do with tracking error and managing risk and those, and perhaps volatility. But when choosing an active manager, we always want to be looking for managers that are sufficiently different that they can generate enough return to overcome their fee hurdle. So again, it's no magic elixir, but it's an important distinction. In active equity portfolios, this is often referred to as active share, but there are other measures like tracking error, and even in fixed income, just being sufficiently different from your benchmark or having out of benchmark exposure. So clearly, you know, to just summarize the manager selection part, I would really just highlight what we care most about is long-term compounding of wealth. We think that people are placing too much emphasis on the persistence of performance. We don't think you can find great active managers simply by chasing past performance, and we don't think people should be overly focused on persistence. And while there's no sort of magic formula, we do think there are a couple of variables and factors that are highlighted often in the research, again, that I covered, focusing on fees, focusing on being different than your benchmark, and potentially having a longer horizon. These are things that come up repeatedly in the research that do not guarantee you'll find a strong or an outperforming active manager, but certainly go a long way to tipping the scales in your favor in terms of having a higher probability of finding a manager that will outperform in the future. And then, you know, as I finish up, I really wanted to talk very briefly about kind of the future of active management and why we're so excited about it. The pressure that passive management in the last decade has brought on active management, I think, is really causing the active management industry to up its game. And I highlight just a few ways here without going into any detail. The continued decline in cost. Again, cost is not all important, but it is important. The emphasis on risk management. Again, there's nothing wrong with owning an index, but we have to admit that if you're simply buying a broad market index, you aren't getting any specific risk management. Remember, when you buy a broad index, you're buying the market, which means you're buying its full upside capture and you're buying its full downside exposure. It doesn't mean that active managers will necessarily outperform in a risk off or a bear market scenario, but at least they have the ability to, or the option to, that by definition, the broad, fully invested benchmarks do not. And we think as markets get choppier, investors will find that trait to be helpful. We think that portfolios are getting more operationally efficient. This is what I was describing earlier. You know, tracking error is sort of going up, portfolio concentration is rising, and managers are focusing their portfolios to be different enough from the indexes to generate alpha over their expenses. And I would finish by saying, not to just bring up ESG because everybody's talking about it, but at the Active Managers Council, we believe that ESG is almost part and parcel of active management. The underlying data on ESG factors really illustrates that they're not very consistent and not very correlated. So as a result, we think that active managers are almost by definition the single best way to implement a sustainable or an ESG focused portfolio. Again, not everyone will agree on the ratings of a particular company, and so as a result, there is a perfect intersection between environmental, social, and governance sustainability ratings and where excess return will come from in stock picking. And so we think ESG is a great frontier for where active management is going. My last slide, Karen, I'll sum it up as quickly as I can. I don't want to take up any more time. The scorecards are important and insightful, but we do think they oversimplify the story. They're helpful, but they're not indicative by any stretch. We see that active managers can and do outperform, but it certainly varies across category, style, time period, and market environment. We think investors can improve their odds of finding a good active manager going forward, and we don't think relying on persistence measure is very helpful. And we think the future of active management is really bright, as in all the ways I just described. It's really adapting to the challenges of the new market environment and the challenges and the growth in assets from passive managers. That's a lot. I went too long, but I'd love to turn it back to Karen or to Darby.
Thank you, Dave. That was great, and I recommend everyone to read this piece. It's really an excellent piece. We did get a question in that's actually a great entree to Darby as head of the research task force. The question is, sorry, I'm scrolling up here. The question is, could you speak more to the idea that not all funds are closed due to bad performance? Is there any measurement we can use of the percent that closed with trailing performance? And in fact, the council is working on a piece that's going to discuss this in greater detail. Darby, do you want to comment on that?
Yeah, I can definitely chime in. Karen, can you hear me okay?
Yes.
Great. And there were actually two very good questions that came along, Dave, which we can field here as we go along. But to tackle this first one on reverse survivorship bias, which you had mentioned, Dave. And the question, Karen just rattled it off, but really just more details around that. And to kind of summarize, I would say, as Dave mentioned, there's been some research that demonstrates reverse survivorship bias, which is essentially saying that funds close for reasons other than just bad performance. It could be because they're merged away due to product line rationalization, mergers, they could be too small to get economies of scale. It could be performance in the entire category. It could be due to the market cycle. There's several other reasons besides poor manager performance. And as Karen said, we're doing a piece on that now. I should mention Teresa chimed in with some answers to some of these questions. Teresa Hamaker, who's part of the research task force at the AMC. I should also nod my cap to her because she does all the work. So please see her responses there if you haven't seen them yet. Look for more research on this. And the last thing I'd say about some data is that Teresa made the point in her comments, and we'll address this in our paper, that passive rates of closure have been not too different from active in some categories. And that would suggest that it may be for other reasons besides performance that funds are shutting down. So Karen, that's how I'd field that first question there. But please, it's a great question. I'm glad somebody asked it because it makes me excited about the work we're doing on that topic.
Thanks, Darby. And it is really exciting. It is really exciting work. Why don't we move on now to your presentation on market dynamics?
I can do that.
Yeah, we'll take more questions at the end.
Okay, great. Because there was another good question about active share, but we'll take that towards the end. So I'll jump into my section here. We've got 17 minutes to go, but I think we'll be good on time. First of all, thank you for having me today. Thank you for listening in. I'm Darby Nielsen. I'm a director of research at Fidelity, and my primary responsibility is head of equity quantitative research. So in that role, over the last many years, we've done a lot of empirical research on active management, whether it's the cyclicality of active, as Dave talked about, the factors that drive its performance, as Dave talked about, or active share, or in this case, market dynamics. And this is related actually to some of the stuff we talked about at the start, the papers we've done on active and market efficiency. And this was a result, actually a lot of times we do this work either for thought leadership papers or for board reporting. And this was a question that came up last summer from our equity board of trustees. And it was a result of some of the headlines that you see on the next slide here. And many of you saw them yourselves, I'm sure. You can see from the bottom up to the top chronologically, Bloomberg at the end of 18. We're getting close to the tipping point from active to passive in February and March. Controls nearly half the US stock market. And then finally, in the summertime, passive catches active in US equity. I should point out that as we go along here, we're going to be focused on US large cap equity, which, as Dave pointed out before, is often the most studied part of the active management performance. So these are the headlines that prompted the question. Before I get into some of my analysis of the market dynamics and how these flows might be impacting them, Karen, if you could go to the next slide. We just wanted to take a deeper dive on the headlines themselves and actually look at the mutual fund assets, but then take it a step further by looking at stock ownership. So on the left-hand side of this page, I'll briefly describe to you what I'm showing. What we're showing in the green is the proportion of US large cap assets that are active. So you see that has been, over the last 20 years, been declining to 49% is the final data point there. And this is all 20-year studies I'm going to walk you through here for the rest of this presentation. On the bottom of this left-hand chart, you can see the total passive, and we're showing two different lines here. The top one is passive mutual funds, and the bottom is passive ETFs. So it's interesting to see that 20 years ago, the passive ETFs was close to zero, but both of them have gradually been trending upwards, such that now the total passive assets are 51%, which is the sum of those two orange lines. So indeed, the headlines 51 to 49 were the case. But then we want to take a deeper dive on this just to understand really what's going on a little bit more. And so on the right-hand side, we're able to use an ownership data set to determine not the proportion of assets, but the proportion of market cap and shares outstanding that are held by active versus passive managers. What's interesting here is you can see the same trend for passive. And this again is taking for the US large cap universe, the proportion of all the shares that are held by these different categories. Passive has continued to go up. Now, what's interesting though, if you go back 20 years ago, active for about 10 years also continued to increase. Now it's about 48%. It's trended down in the last 10 years. But what's left over besides active and passive institutional owners is the retail ownership. And so you see that's the blue line, which at the very end of the 90s, there were a lot of retail stock owners. Initially, passive took share from them and has continued to, but has gradually taken share from active. So this is just a quick dive into the data to show that US large cap retail funds are indeed roughly 50% of the assets, but passive is a little bit lower as a share of the total market. So Karen, let's go to the next slide, because here's where we start taking a deeper dive on the passive flows that I just showed you on the prior page, which we demonstrated and corroborated the headlines. But now we're going to get into some of the market dynamics that might be impacted. And I would certainly turn your attention to the papers that we did with the AMC. One was the Russ Wermer's paper that we published last year, but also the AMC did a white paper, as Karen mentioned, that does a survey of the literature and looks at a lot of the papers out there and how passive may be impacting market dynamics. So, you know, the first thing I want to point out here is there's been a lot of academic studies, dozens of them. Professor Wermer's did a good review of those, but then our own AMC piece, thank you again, Teresa, did a good review. Before I get into some of the analysis and details, I want to highlight 4 important dynamics that many academics have studied, and we're going to walk through here in a moment. The first is how much stocks are moving together. You probably hear about this or see articles about it, but it's correlations in the marketplace. How much are stocks moving in the same direction together? In some cases, you might expect stocks to move in the same direction based on their industry, but in general, are stocks moving more in the same direction instead of different directions? We'll take a peek at those correlations in a moment. The second really gets to pricing and whether or not stocks are moving along with their fundamentals. Now, the way we've defined that here is whether or not the payoff to earnings has changed. And the way I think about that, and at Fidelity and many other places, we know that stocks follow earnings. And so we think that this hypothesis would suggest that if the stocks aren't responding to fundamentals as much anymore, then the payoff to earnings and getting earnings right and the reward to earnings growth should be changing. The third one is just opportunity in the marketplace, how much return variability there is, and market volatility. I'll show you what I mean by that as we go along, but presumably, if there are more passive flows going into the market, making stocks move in the same direction, it may either mute market volatility or opportunity, or it may increase it, and we'll take a look at that in a moment. And then finally, I think there's an argument that, the more assets are controlled by passive investors, the less active trading goes on. Active managers, as we all know, we understand that they have a very important function in the capital markets in terms of pricing. That's the second one I mentioned, ensuring that stocks are priced appropriately with their fundamentals and their underlying values. But if more flows are going to funds where they just track a market cap, does that mean that there's less active trading going on as well? So those are 4 things we're going to look at. Karen, if you go to the next slide, I'm going to do a deep dive on correlations. And as I go through each one of these, bear with me as I talk you through what each chart is showing. Again, it's all 20-year analysis. Again, we're looking at a US large cap equity universe. In this case, it's the S&P 500. But what we're showing on this chart is 2 lines. And for each line, every point, we're looking back at the last 3 years within the S&P 500, all the correlations of the stocks with each other and how much they're moving together. Where if it's a 0, it means every stock is moving in different directions, and a correlation of 1 means that they're moving all in the same direction. So you can see here it ranges from 0 up to 0.5. Actually, I should say the correlations could be negative as well, meaning they're moving in opposite directions. But you would expect to some degree stocks to move in similar directions because they're all part of the equity market responding to the US economy or global economy. But you can see over time, we're showing 2 different lines. They're both 3-year trailing windows, but the blue line labeled daily is looking at daily correlations of all the stocks with each other. The green line is quarterly, looking at quarterly returns and how the stocks move with each other. Now, the reason we looked at 2 different lines here, 2 different data sets, is to determine if in the short term, are stocks moving in the same direction versus over a longer term. And I'll use some examples here. You would expect perhaps Home Depot and Lowe's to zig in the same direction, but perhaps Microsoft to zag in another direction. If correlations are going up, it would mean that these 3 stocks all kind of zig in the same direction. So what we see on the daily line and the quarterly line is they kind of peaked in 2012, which actually it's important to note that the flows have continued to go into passive ever since then, yet these lines have gradually gone down. But what's interesting is the daily correlations seem a little bit higher, meaning in the very short term, stocks are moving in the same direction together. But in a quarterly basis, it looks like it's back in line with history. So it doesn't necessarily appear that there's much of an effect here, maybe in a very short term basis, but on a quarterly basis, again, going back to my Home Depot and Lowe's example, on a quarterly basis, you would expect them to move a little bit differently because they may have different quarterly earnings as opposed to on a short-term basis responding to macroeconomic data. So that's on a correlation analysis. Let's go to the next slide, Karen. Again, I'm going to briefly walk you through here what we've got. This is a really fun study we do periodically, which is just determine how much are stocks following earnings. And in this case, it's earnings surprises. So I should mention it first, what we're showing in the blue here, the columns on the left-hand side, if you held the top 20% of stocks in the Russell 1000 large cap universe, and you knew those top 20% that were going to have the most positive earnings surprise, how much money could you make? What would be the excess return? Now, what's key here is that you can see those blue bars are almost always above 0. And there's some big payoffs, which means that if you can identify the earnings surprises and hold that top 20% of stocks, you can generate a lot of excess return. And as an aside, I would say this is the importance of fundamental research to identify which stocks are going to beat earnings expectations. And this demonstrates the importance of fundamental research and how much alpha could be had through active management. So that's the blue. The red is just showing the median relative surprise at any point in time, which you can see kind of follows the earnings surprise. You get paid more money for getting the earnings surprises right when the relative surprises are higher. But the punchline here, and again, what we're trying to gauge is how much perhaps is the market no longer following earnings or fundamentals. What's interesting is that forecasting earnings, as I mentioned, is a very winning strategy. You can really generate a lot of excess return, but it does appear that it's been a little less rewarding in recent years, which could be due to competition. It could be due to more data availability, lots of different things besides passive management, but it does appear like there might be something here. So Karen, let's go to the next slide. And I'm going to cover these last couple topics, and then we'll wrap up and go to more questions. But I talked about fundamentals and pricing and stocks follow earnings. And I talked about correlations, where it looks like in the shorter term, correlations might be a little bit higher and fundamentals might be a little less rewarded. I want to go to those other two dynamics I mentioned that we should monitor, which is market volatility and opportunity and trading volume. So the top chart is showing expected volatility, which is the VIX index that we're all familiar with. What we can see is that it actually has been somewhat lower, but really it's been kind of in line with where it was before the financial crisis. You can see that it jumps quite a bit in the financial crisis and other periods, just like it has in the last couple months. But for the most part, it looks similar to where it was in the past. The second graph is showing something similar to volatility, but it's looking across the market and measuring return dispersion or variability, or how much difference there is from the best performing to the bottom performing stocks. Where when it's very narrow, it's hard to generate more excess return, but when it's very wide, there's a lot of difference and there's more opportunity to generate alpha. Just like the VIX, it seems like it's been muted, but I would also argue it looks kind of similar to where it was in the first half of the data set, the first 10 years. And then the third topic that I wanted to cover is trading volume. This is an interesting one because it is the case that the number of listed securities has gone down in the last 20 years. Depending on how you measure it, it's gone down quite a bit. But at the same time, trading costs have gone down dramatically. And we now have more high frequency traders. So this argument that passive means there's less active trading, I think is being offset by other factors like high frequency trading and lower trading costs. And what you see here again is that it looks like it's in line with historical levels. If you kind of looked at both halves of all three of these charts here, it looks like the averages are roughly the same. But I want to leave you with a final insight, hopefully, because what we're showing on the bottom graph is GDP growth. This is just showing GDP growth for the US economy each quarter. And what you see in the first half, it was somewhat volatile, jumping around. Then we had the financial crisis when the GDP shrunk. But then it's actually been pretty steady, or at least it was until the last couple of months, over the last 10 years. And the point here is that there may be other reasons to explain what's been going on with these market dynamics, other than flows to passive. So that's my review. The punchline is that when I look at these four dynamics, it looks like there might be something there with short-term correlations, returns to fundamentals. Volatility and dispersion and trading volume seem similar, but all of which could be explained by the economic cycle as opposed to flows to passive instruments. So I know we're getting close on time, Karen. I'll turn it back to you, and we could take a few more questions. I know we had the question before about active share.
Thanks, Toby. Really appreciate the presentation. Want to just ask, as head of the research task force, what additional research are you all planning ahead?
Yeah, so we already touched on one of the pieces, which is the reverse survivorship bias, where Therese and I are putting a piece together to do a deep dive on that, which is why I was excited to get the question. We also recently, as an example, we on an ongoing basis are putting posts on the AMC website. I hope people are going out there to take a peek at some of our research. We recently did a blog post on all the market volatility and the importance of active management for efficient pricing. So it kind of gets to these market dynamics and fundamentals that we talked about, but also those papers Karen mentioned at the start, and the importance of active management for pricing, assessing earnings, prospects, and underlying values, and how active management is very important in a time like this to determine the underlying values when the market may overreact or underreact. That's a second thing. But then the third thing I really want to mention, and it's related to what Dave talked about in terms of the future of active management, we want to do a piece on ESG. ESG is a very important topic. It will grow in importance. And we've done a lot of work on it at Fidelity as well as a lot of other shops, looking at a lot of different data sets and different providers, different ways to gauge ESG. And as Dave talked about, ESG is in the eye of the beholder. We've looked at two very popular data sets, and you can find really different correlations between almost the same variables. And the point here is that ESG is very much an active decision. It's almost inherently active, how you define ESG. And I actually think of it to some degree, sorry to digress slightly, but to some degree, it's like factor products. A lot of factor products out there are actually ultimately index products, but how you define them can be dramatically different, which is why I think factors, ESG, even if it's passive by implementation, they're active by design. So that's a handful of things we're working on, Karen. Thanks for the question.
Thanks, Darby. We've just about run out of time, so I'm just going to let Dave close as chair of the council with what do you think is the value of the council to Natixis and to managers?
Thanks, Karen. You know, at Natixis Investment Management, we have both active and passive. We are predominantly active. We are huge believers in active management. And from our standpoint, the Active Managers Council has been one of the most effective tools for getting that message out, for driving increased research on the topics that we find helpful, and for driving kind of a communication outreach across the industry that no one firm by itself could do. So Darby has already talked extensively about the work done by the research task force. Most of the firms could not, you know, produce that level of research on their own. There's a policy task force that works with regulators and other industry organizations to try to put forth ideas around active management. And as you said, Karen, leveling that playing field. Again, that outreach is stronger than any one firm could do on its own. And then the third thing is really the communications task force, between everything we're doing in social, digital, and really driving a lot of media engagement. Again, it would be very hard for one firm to do that. So from Natixis's standpoint, we get all the things that we want. We drive all the messages, but we drive it with industry wide scale. We drive it with the help of all the firms that you mentioned, Fidelity and MFS and AMG, and all the steering and at-large members. And for us, that's just a really good use of our dollars to try to get that message out there and have a broader impact that any one firm could have on their own.
Thank you, Dave. And again, if anyone out there would like to learn more about the council or would like to join our efforts, please reach out to us. We would be happy to chat. Thank you, Dave and Darby, for a terrific presentation. Really appreciate all the work that you do for the council and for our industry. And thanks to all of you for participating. Have a great afternoon.
Thank you, everyone.
Thank you.